Experts are split 50-50 on whether 2026 brings runaway inflation or crushing deflation. The 1% don't pick sides. They own both. Their dual hedge exposed. Welcome back to Wealth Architect. I'm Dr. Ben. Today we're walking through the one blueprint the wealthy quietly rely on when the economy could swing either direction in 2026. No predictions, no guesses, just ownership that delivers in both worlds. Stick with me. By the end, you'll have the exact mix, real proof, and the step-by-step plan you can put in place this month. Number 1. The inflation scenario most people fear. What 2026 could actually feel like in your daily life. Picture this exact timeline unfolding next year. Government debt interest payments keep climbing faster than expected. Supply chains stay jammed from trade realignments and energy politics. Fuel, food, housing, insurance, and everyday goods start rising 8 to 12% year after year. Your paycheck number stays flat, but buys noticeably less at the store. The $150 grocery run becomes $180, then $210. Rent or mortgage feels heavier because everything around it costs more. Bank savings quietly lose ground because the tiny interest does not keep up. Bonds drop in value as rates stay elevated. Stocks in companies that cannot raise prices fast enough get squeezed even if the broader market looks choppy. This is the slow wealth transfer most families experienced in the 1970s and again in 2021-2023. Your home equity might look bigger on paper, but property taxes and upkeep eat the gains. The standard retirement plan built for calm times starts leaking real purchasing power. That is the exact problem we solve first today. Number 2. Historical proof from real inflation cycles. What actually happened to regular portfolios? Look back at the 1970s double-digit inflation years. Families who owned only stocks and bonds watched real returns turn negative for almost a decade. Cash in the bank lost 60 to 70% of buying power over the period. But the households that held physical gold saw it rise over 2,000%. Farmland values doubled and kept producing income. Energy producers with real assets delivered cash flow that grew with prices. Same pattern repeated in 2021-2023 when inflation spiked. Paper assets lagged while tangible producers protected and grew real wealth. These are not theories, these are documented outcomes that show why the usual buy index funds and wait advice quietly fails when prices run hot. Number 3, the deflation scenario that catches everyone off guard, the hidden danger of falling prices. Now flip the picture completely. 2026 sees tighter credit, weaker consumer spending, or a sudden productivity jump from AI across industries. Prices start dropping. Groceries feel cheaper. Gas feels cheaper. At first, it sounds like relief, but wages fall faster. Jobs get cut as companies tighten. Debt you already owe becomes heavier because each dollar is worth more while your income shrinks. Real estate values drop sharply because buyers vanish. Stocks in everyday companies lose 30 to 50% or more. Even broad index funds built for steady growth get crushed because the companies inside them see revenues dry up. This is exactly what turned the 1930s recession into the Great Depression and nearly repeated in 2008-2009. Your home, often your largest asset, can go underwater. Your retirement account, built on decades of steady growth, suddenly loses value faster than you can save new money. Cash earns almost nothing while better opportunities disappear. This is the scenario most retirement plans are not built to survive. Number 4, why deflation hits harder than people expect in 2026. Specific triggers already visible. Current signals point to possible deflation triggers, slowing global demand, AI-driven efficiency gains cutting labor costs, and central banks keeping policy tight longer than expected. When prices fall, companies cut costs aggressively, leading to layoffs. Debt burdens rise in real terms. Banks pull back lending. The usual safe assets, like government bonds, deliver tiny yields that do not cover lost opportunities. Real estate sits unsold. The average investor who followed conventional advice finds their portfolio frozen, while the cost of living still feels high because wages lag. This is why we need a plan that does not rely on rising prices or steady growth. Number 5, the trap of standard investment advice in both worlds. Why most plans break. The classic 401k max out in index funds approach was designed for mild 2 to 3% inflation and steady 7% market returns. In high inflation, those funds struggle with rising costs and real returns shrink. In deflation, demand collapses and the same funds lose big. Cash as an emergency fund loses buying power in inflation and sits idle in deflation. Long-term bonds get crushed when rates rise and deliver almost nothing when rates fall. Even real estate, often called the ultimate hedge, has traps. Taxes and maintenance climb in inflation, while buyers disappear in deflation. These strategies were built for a predictable world that no longer exists. The 1% never used them as their core. They built something different. Introducing the dual resilience blueprint, the one mix that delivers no matter the direction. The 1% own a focused collection of real, productive assets that produce cash flow and hold real value whether prices rise or fall. These are not bets on one outcome. They are ownership of the things society always needs: food, energy, shelter, and proven stores of value. In inflation, these assets rise with prices and generate higher income. In deflation, they keep producing essential goods and services, while paper assets collapse, drawing capital as the ultimate safe choice. The mix works in stagflation too, because it benefits from rising prices while still delivering steady real-world output. No prediction required, just ownership of the economy's backbone. Core Asset 1, physical gold and silver, your store of value that performs in both scenarios. Physical gold and silver act as the anchor. In inflation, they preserve purchasing power while paper money loses it. In deflation, they become the preferred safe haven as investors flee collapsing markets. Hold them in bars, coins, or allocated storage, not paper versions for the core position. Historical data shows gold rose over 25% during the 2008-2009 deflation panic, while stocks fell more than 50%. In the 2021-2023 inflation period, it held steady, while bonds dropped double digits. This is your insurance piece that never relies on dividends or rents. It simply holds value. Core Asset 2, farmland and timberland, the real producers that feed and build the world. Farmland and timberland deliver food and wood that society demands every year. In inflation, rising food prices boost revenue. In deflation, these assets still produce and become preferred holdings because they generate real output. Institutional money poured billions into productive land during both recent cycles.
You can access this through direct ownership or high-quality funds and REITs focused on working acreage with strong water rights and soil quality. The income from leases or harvests compounds regardless of price swings. Number 9. Core Asset 3. Energy and essential commodity producers, steady cash flow machines. Own well-run companies in oil, natural gas, utilities, and low-cost mining with strong balance sheets. These operations deliver dividends and cash flow because the world needs energy and raw materials constantly. In inflation, they pass on higher prices. In deflation, their production remains essential while many other sectors shrink. Look for firms with long-term contracts and conservative debt. This bucket keeps money coming in while the rest of the market may be volatile. Number 10. Core Asset 4. Income-producing real estate. Properties with reliable tenants and conservative financing. Focus on residential or commercial buildings with long-term leases and low debt. These generate rental income that adjusts upward in inflation and remains stable in deflation because shelter is always needed. Avoid highly speculative developments. Conservative financing keeps cash flow reliable even if values fluctuate short-term. This is your tangible shelter and income generator in one. Number 11, the liquid reserves safety net, cash ready for opportunities. Keep 15% in short-term treasuries or cash equivalents. In inflation, this piece stays protected. In deflation, it lets you buy quality assets at steep discounts when others panic. This is the flexible part that turns market fear into your buying opportunity without selling core holdings. Number 12, exact allocation percentages the 1% actually use, the balanced mix you can model today. Top family offices use roughly this range when uncertainty is high. 25% physical gold and silver, 25% farmland and timberland, 20% energy and commodity producers, 15% income-producing real estate, 15% liquid reserves. These percentages are tested across decades. Inflation lifts the first three buckets. Deflation protects them, while the liquid piece gives you firepower. Rebalance once per year and always prioritize cash-flowing assets inside each category. Number 13, step-by-step implementation guide for any account size. Start today. You do not need millions to begin. Start with 5 to 10 ounces of physical gold for immediate exposure. Add farmland or timberland through listed funds or REITs. Build energy and real estate positions inside tax-advantaged accounts using quality dividend payers. Keep liquid reserves in treasury bills. Track everything in a simple spreadsheet showing your real exposure. Add consistently. Once the core is in place, the portfolio almost runs itself. Number 14, tax and legal considerations for maximum protection. Use retirement accounts where possible for commodity and real estate holdings to defer taxes. Consider direct ownership structures for larger accounts. Work with a trusted advisor familiar with these asset classes. Proper setup keeps more of the cash flow working for you instead of the taxman. Number 15, common mistakes to avoid when building this hedge. Do not chase paper ETFs for the gold and farmland core. Own the real thing. Do not over-leverage real estate. Do not ignore rebalancing. Do not treat this as a one-time setup and forget it. Stay focused on cash flow inside every bucket. Number 16, real case studies from modern family offices, proof you can see. Look at the families who preserved wealth through the 1970s inflation and 2008 deflation. Their holdings in gold, productive land, and essential producers delivered income and stability while standard portfolios collapsed. The same pattern repeated in recent cycles. These are not lucky guesses, they are repeatable ownership decisions. Number 17, how this blueprint performs in stagflation, the worst of both worlds. When inflation and slow growth hit together, gold and farmland rise with prices. Energy keeps flowing. Real estate generates adjusted rents, and liquid reserves keep options open. This mix was built exactly for messy environments like that. Number 18, your 30-day action plan. Turn knowledge into ownership. Week 1, open or review accounts for gold purchases. Week 2, research and allocate to farmland or timberland funds. Week 3, add energy and real estate positions. Week 4, set up liquid reserves and create your tracking sheet. By day 30, you have the foundation in place. You now hold the exact blueprint the 1% use when headlines scream two opposite futures. No more guessing, no more watching your purchasing power disappear or your portfolio get crushed. Just quiet ownership of the things the world cannot live without. If this gave you the clear path forward you have been searching for, do these 3 things right now. Hit the thumbs up so more people who need this exact information can find it. Drop a comment with one word, inflation or deflation, and tell me which scenario you are preparing for. I read every single one. Subscribe and turn on notifications so the next blueprint drops straight into your feed the moment it is released. This is Dr. Ben from Wealth Architect. You have been given the blueprint. Now go build it. I will see you in the next episode where we break down another piece of the architecture the wealthy actually use. Until then, design your freedom.